Here we go again, live from New York City this morning. Good morning, with your S&P 500 down just a couple of tenths of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Here come the downgrades.
We're seeing a lot of headwinds.
All of these really huge headwinds.
Notably lower growth, and we're going to see frustratingly high inflation.
A very challenging growth inflation mix.
Stagflation, unfortunately, is the baseline.
Stagflation is toxic for traditional assets.
Is it a soft landing? Is it a recession? Is it stagflation?
It started out as an inflation scare.
Wall Street's biggest concern is inflation.
Then it became a growth scare as well.
There's a lot of conflicting signals.
Whether we get something worse depends on the soft landing debate for the Fed.
The Fed is effectively trying to thread a needle wearing oven mitts blindfolded.
It's a very small needle to thread.
It may end up hiking too much and pushing us into recession.
There's just generally so many headwinds.
Joining us now to discuss FlowBank's Esty Dwek, Bank of America's Cabana. Esty, first to you. Have we seen the worst of this yet?
I'm hoping, but we probably haven't. There's still a lot of concerns. We got some disappointing data from China today. We don't know the impacts yet from the Shanghai lockdowns and if that's going to impact inflation and sort of force the Fed to hike more than they want or than they would in other circumstances. And we just see that there's a lack of buyers in this market. There's still a lot of fear. And so we probably have a little bit more to go on the downside.
Mark, you don't think we have in the bond market either. I'm looking at your 2-year call. 2-year right now, 258. Are you guys at 350? Mark Cabana, can you run me through that? How we go from here to there?
Sure, yes, we are. We think that this inflation backdrop that we're seeing today is likely going to warrant an ongoing tightening from the Fed beyond what the market is currently pricing. Our base case, our economist forecast is for Fed funds to reach 3.5 to 3.25% by May of next year. But we do see risks that it could potentially be higher or that the timing could be faster than we currently anticipate. And this is really due to the fact that inflation is too elevated and the real policy path, the real policy rate is too low. We think that the Fed needs to tighten financial conditions more in order to get that inflation slowdown. And unfortunately, that's probably going to mean more turbulence for markets ahead.
Mark, what's your inflation forecast going through the rest of the year? What pushes the Fed to make this call?
We've got core PCE at 4.1% by the end of the year, in line with the Fed. And then by the end of next year, that's 2.5%. So it's moderating, but it never goes back to where the Fed's 2% target is, at least over the next 18 months or so. And as a result, we think that the Fed is going to be frustrated by sticky high inflation, a labor market that is still very strong, and it's probably going to have to do more tightening than the market currently anticipates.
Esty, what would that mean for you? 350 on a US 2-year.
That would mean a lot more pain because if the Fed continues to hike and doesn't at some point, let's say around Jackson Hole in August, start to acknowledge that it has to keep an eye on growth, the expectations that they will manage that all-elusive soft landing are going to vanish completely. And then I don't think we're pricing in a full recession. We're certainly pricing in a growth scare. We're starting to price in something of a hard landing, but we're not pricing in a recession in the U.S. at the moment. And that means more downside for the equity markets as well, in addition to a lot more pain in the bond side. So I'm hoping then that the Fed sees the gradual descent of inflation, this disinflation, even if it's slow, that we're going in the right direction. And then at some point they acknowledge that they have to keep an eye on growth and they have to keep an eye on the labor market.
So David Costner Goldman put out his work over the weekend, going into the weekend. That was one of the downgrades we've talked about throughout this morning. On the S&P 500, they've come down from 4,700 to 4,300. They think the gains are going to be at the back end of this year. They say we assume as the year progresses that investors will gain confidence about decelerating inflation, the path of the Fed, all of the above, recession risk and equities will rise modestly. It's their 3-month call that gets my attention. Esty, they said our 3-month forecast is 4K. The reason being is that equity markets going higher would ease financial conditions, and that is not what this Fed wants. And it kind of echoes what Mary Daly of the San Francisco Fed said last week. They want tighter financial conditions. Esty, in many ways, are they just giving the game away for the rest of this summer? This Fed wants equities lower and credit spreads wider.
I mean, those are two of the biggest components in your financial condition index. So you have to assume that I don't think they want equity markets lower, and they shouldn't underestimate the wealth impact in the U.S. and how the U.S. consumer is going to feel very quickly compared to the poorly, I'd say, compared to the last 2 years. But they certainly don't think they've tightened enough yet. I think they still are thinking about front loading. So we get 2 more 50 basis point hikes. That has probably a further impact on equities and on credit spreads because they're going to keep that rhetoric quite hawkish in the short term. And again, later in the summer, hopefully, then they start to acknowledge that they've done quite a bit. When you think about re-anchoring those long-term inflation expectations, your 10-year tips are still at 2.6 something. They're not outrageous. It's just the next 12 months. And it's having that patience to watch inflation come down very slowly. And those next 2 months, I think, are going to stay quite painful for the markets and with their rhetoric.
And Mark, this is what I hear a lot. Esty's gone through it, kind of echoes what David Costin over at Goldman's saying as well. You get to the back end of the year, things start to improve, maybe the Fed backs off. Your call and the essence of your call is that they don't, they can't, and they won't. Do you get that pushback in your client conversations too, Mark? And what do you say back to them?
Yes, so we are hearing that pushback a bit more, but it's consistent. Our view is consistent with the notion that the U.S. labor market has been very tight, is slated to tighten further. The economy has a lot of momentum, and that the Fed is going to have to put policy into place such that financial conditions tighten and such that overall consumption slows. That's the only way that the Fed can get inflation under control. And a lot of the pushback that we get is, well, what about the equity put? What about how tight financial conditions need to go? What can the Fed do about this? And our view is that, look, right now, when the Fed looks at the strength of the economy versus the inflation outlook, they have an inflation problem. They need to keep going, and they need to credibly ensure that inflation falls. We're still seeing inflation surprise to the high side for now. And so that just means that the Fed is going to have to remain in a relatively hawkish place and keep going. And if they don't see that inflation begins to moderate, and again, we saw a pretty big beat on core CPI last week. Yeah. Yes, it was influenced by airfares, but it was still more elevated inflation. If they don't see that inflation starts to fall in line with their forecasts and with the street's forecasts, then they're going to have to keep policy in a tight position. And the trade-off must then be that they're going to accept a little bit slower growth in order for lower inflation.
Mark, it seems to me that our relationship with financial conditions and how that relates to the Fed is very much stuck in the previous cycle. We keep seeing these moves in the market as problematic for this Fed. That's how we used to look at it. Are you saying it's a feature, not a bug?
This is how they impact the real economy. And if the Fed is going to slow inflation, it is going to be through financial conditions. Now, let's not forget the fact that financial conditions have eased a tremendous amount over the last few years. The Fed erred on the side of providing too much accommodation, arguably for too long, but they did that in light of the very sharp economic slowdown that we saw right after the pandemic. And so now what the Fed has to do is get the economy back into a better equilibrium. They've got to take some of the air out of financial conditions. That's exactly the direction that they're moving in. And right now, policy is still extraordinarily easy. The real policy rate is still deeply negative. And this is something that the Fed is going to have to fix if they do want the economy to reach a better equilibrium and for inflation to moderate and get close to their 2% objective.
22 minutes away from the open and bow futures, negative about 0.2% on the S&P 500. Katie Lyons, we have had a ton of downgrades over the weekend.
Yeah, strategists have to play catch up, right, John? Because this year has just gone a lot worse than pretty much everyone anticipated. Back in January, the average strategist thought the S&P would rise about 5% this year to around the 5,000 level. We're now down 16% year to date, trading around 4,000. And he also didn't see people getting it right in the bond market either. The consensus at the start of the year was that the 10-year yield would hit 2% by June. Instead, it hit that in early February and touched as high as 3.2% earlier this month. So strategists having to rapidly adjust to this market. Actually, almost half the equity strategists tracked by Bloomberg, have lowered their year-end targets. Goldman, as you were mentioning, is among them. Plus, analysts that focus on specific names are also slashing their price targets at the fastest pace since the pandemic crash of 2020. What we're looking at here is the number of daily price target cuts. You actually saw one day last week where there were 130 cuts on a single day. The average over the past 20 sessions has been about 80. And of course, part of the reason for that is the deteriorating growth outlook. Slower growth, of course, could start to weigh on earnings. And on the growth side, the downgrades are hitting there as well from Goldman as well over the weekend, cutting its outlook for both this year and next. The view for 2022 lowered to 2.4% from 2.6%. And out in 2023, John, slashed from 2.2% down to 1.6%.
Kelly Lyons, thank you, as always. I always enjoy the Mike Wilson note from Morgan Stanley. Comes out on a Sunday just to start or end your weekend and start the week. And he says something bearish and then it ends it with, enjoy your Sunday. Let me see if you enjoyed your Sunday once you read this. On the S&P, this is what Mike Wilson thinks could happen here. We remain confident that lower prices are still ahead. In the S&P 500 terms, we think that level is close to 3,400, which is where both valuation and technical support lie. Before he wrote that, he wrote this. With valuations now more attractive, equity markets so oversold and rates potentially stabilising below 3%, stocks appear to have begun another material bear market rally. Esty, can I come to you on that? Would you call what we're seeing play out at least a couple of days ago a bit of a squeeze, a bear market rally, but ultimately we haven't seen the lows yet?
You know, we're flirting with that 20% mark, whether it's a bear market rally or not. I agree that for now they're going to be relatively short term and that there is further pain. The technical picture, I also have to agree that is still pointing to further downside and further pain. So at the moment, it does feel like these rallies are going to be violent, but probably short, and that a lot of people are going to want to fade them until we feel that we've had something of a more solid bottom at some point, probably and hopefully in June, that can come and give confidence for investors to come back in. But at the moment, for the next month or so, it doesn't feel very attractive. It doesn't look very attractive. And if what we were saying earlier about the number of rate hikes to come, then we're going to have even more concerns about growth and possibly another re-rating of valuations for equities.
Esty, do you have any confidence that in Mark's world, things have stabilized in the Treasury market?
You know, it was interesting to see that your Treasury yields are coming down while your equity markets are coming down, so that positive correlation appears to have at least paused, if not broken for now. It's also interesting to see the VIX come down a little bit, despite what we saw in the markets last week. So at some point, we are starting to see incremental better news and some positive signs for the markets. We're hearing that Shanghai should be reopening relatively quickly over the next couple of weeks. We are seeing that inflation is pointing downward, maybe not fast enough, but at least in the right direction. So we're starting to get those positive signals. But I think if the Fed sticks with this hawkish rhetoric for a very long time, you're going to have that growth picture start to worry investors, and that could weigh on markets a little further.
Right on cue, we're getting some Fed speak. It's from the New York Fed President Williams. He says the following: we need to get real rates back to zero in the next year or so. Mark, that is your view. It's the real rate view, not nominal rates, real rates. They think we need to get back to zero. Then he expects inflation to decline quite a bit next year. Mark, talk to me about that. Just really hit home that story, that message that you've got with the team at B of A, that it's not about nominal rates, it's about real rates and where you think that needs to be.
Yeah, Jonathan, this is a great point. This is exactly what we've recently been arguing, and it's actually what we use to justify our forecast revision somewhat higher. It's the fact that when the Fed has recently talked about the neutral rate, they've been talking about the nominal neutral rate, right? Powell says, well, we want to hike until we get to neutral, which is 2 to 3%, he says. But when he talks like that, we hear him talking about the nominal rate, i.e. the one that includes inflation. And we know how high inflation is today. And as a result of that, the nominal neutral rate is not a particularly relevant concept. What matters if the Fed wants to get a handle on inflation is where the real policy rate ultimately ends up. And we completely agree with New York Fed President John Williams. We were writing about how we thought Fed rhetoric was going to shift in this direction to focus more on the real policy rate. And as a result of that, the Fed has to keep hiking rates quite quickly, at least in the near term. Now, we don't know exactly when they want to get the real policy rate positive. If it's by the end of the year, then the Fed ultimately needs to get the policy rate above 4%. We think that's probably a bit extreme. The Fed's likely looking forward on where inflation is headed. But even if they agree that inflation is going to be around 2.5% by the end of next year, then the Fed funds target rate has to be above that, and probably quite a bit above that, in order to try and slow the economy. So we continue to expect a lot more discussion and focus from the Fed on not just the nominal neutral policy rate, but the real rate, which is what's going to matter for the economy. And that's what's really going to slow financial conditions. Seems like the Fed is indeed moving in the direction that we've recently been thinking and writing about.
Mark Cabana sticking with us alongside Esty Dwek. Want to get you some moves ahead of the opening bow with futures just a little bit softer. Here's Abby.
John, beneath that relatively flat surface, we do have some outsized movers, starting off with the shares of Spirit Airlines soaring. This on a hostile takeover bid from JetBlue for $30 in cash, better than Frontier's roughly $19 cash and stock bid. But you can see the stock trading still closer to the Frontier bid. More drama to come, perhaps. Cabana also up sharply as the used car retailer soaring on a strong earnings outlook. Plus, they are cutting costs to the downside, though. Last Friday, of course, was all about that big tech rally. We have NVIDIA, one of the top performers last Friday, up about 9.5%, the best day at that point since March. Now down, giving some of that back. And Twitter, John, heading to its 7th down day in a row, of course, losing about 20% over the last 6 days as Elon Musk's bid is on hold. Can Twitter make it an update? Right now, not so much.
Seeing that in the 30s with an agreed price of $54.20. There's a spread. Abby, thank you. Coming up, China's economy paying the price for the nation's COVID-0 policy.
We see the shock out of China documented by the numbers overnight. And there's a pretty awesome decline in industrial production that we saw, a super awesome decline in consumer spending.
That conversation up next.
Zero tolerance for COVID is here to stay. That's the policy of the land. They're going to tough it out. So I don't see any sign of them breaking right now. We see the shock out of China documented by the numbers overnight. And there's a pretty awesome decline in industrial production that we saw, a super awesome decline in consumer spending. We're looking at a contraction for the second quarter, almost certainly.
Some pretty dire forecasts for that economy. The economy in China buckling under the country's stringent COVID-0 policy. Industrial output, consumer spending, all plunging to the worst levels since the beginning of the pandemic. This as auto sales came to a halt. Here's a stat for you. Not a single car sold in Shanghai last month, with 25 million residents under lockdown. Mike McKee has more for you. Morning, Mike.
Morning, John. You got to love the way Carl put it. A super awesome decline in retail sales. They were down 11.1% on a year-over-year basis in the month of April. And we saw a decline in industrial production of 2.9%. Everybody focused on Shanghai and Shenzhen being shut down. But a lot of other important cities in China were shut down, too. And you can see that the results we got out of that, and the one thing I hadn't mentioned is the yellow line there is unemployment rising. We're back to where they were at the height of the pandemic. So it is causing a lot of damage to the Chinese economy, which means it's going to cause a lot of damage to the global economy. Shanghai, they say, is starting to open up, but won't get back to whatever normal is until sometime in mid-June or after. Citi and Morgan Stanley cutting their GDP forecast. And as you heard Carl say, a lot of people expecting this second quarter to go negative, including Bloomberg. You look at what's happening with global supply chains. We saw that in the Empire results here in the United States, plunge into negative territory for the month of May. So where does it leave us? Kind of worried. The Chinese have not been cutting their main interest rate. They've cut the reserve ratio. But as you can see, we don't have a lot of credit demand in China. So it doesn't really matter at this point. They're not getting much bang for the monetary policy buck. And is there really more stuff they can build? And that's why you see in the Bloomberg monthly index there, it's starting to go below zero in terms of total growth. It's not going to be good news for China or for the world.
Some of these numbers are brutal. Mike, thank you. Esty Dwek and Mark Cabana with a final word. Esty, how tough is it, how uncomfortable is it to get long Europe with numbers like that out of China and the situation evolving as it is in Ukraine?
I think it's very difficult, definitely, to be overweight Europe. When you look at the numbers out of China, when you consider the size of the import and export market that China represents for Europe, these lockdowns are going to continue. They aren't going to help with the inflation picture. Although, again, we're getting a little better news in Shanghai. You couple that with the refugees, the food prices, the energy prices for Europe that are still so dependent on gas and not just Russian oil. And the picture is really looking recessionary, at least in pockets, and potentially much more than that. And I think European equities have actually been resilient considering this backdrop, but I wouldn't expect them to outperform.
Mark, this gives you the final word. We've got a slowdown in China, slowdown in Europe. A lot of people arguing for recession, tighter financial conditions, and the Fed's hardly got moving just yet. You think they're going to have to do a whole lot more work. If people say to you, well, Mark, look at how sensitive things already are, and we've hardly gotten started. QT doesn't even begin until next month. Why do they have to go a whole lot further, given everything we're already seeing play out?
Certainly, there's downside risks to the global economic backdrop, and the Fed will be taking that into consideration, as they already have. But the truth is that domestically, inflation is still far too high for them to accept. Monetary policy is still far too easy for them to accept. And they actually have to get policy in an outright tight position if they want to have any hope of seeing inflation fall. Now, the real question for the Fed is, can they get this balance right? Slowing the economy in order to bring inflation down while there are global headwinds to growth. Are they going to be able to engineer the soft landing, or are they going to overdo it as they've typically done?
Yeah.
We see risks that they end up overdoing it. We see risks that they end up tightening a bit too far in the face of an economic slowdown that probably inverts the curve. And it may indeed stop them out of tightening if they see a recession that's clear in the US. But in the near term, economy remains strong. The Fed has to keep tightening in this type of environment, and they need to see clear signs of domestic slowdown, which we don't see quite yet.
Starting to see it just a little bit. I know your view, though, Mark. We're going to see a whole lot more. Mark Cabana, Esty, Dwek, your morning calls up next. Stocks down, here are your morning calls. JP Morgan upgrading Cigna to overweight, highlighting a favourable valuation. Wedbush upgrading Netflix to outperform, highlighting management's move to address saturation. And finally, DB cutting its Ralph Lauren price target, pointing to a weak setup ahead of earnings. Up next on the programme, Peter Tchir of Academy with futures negative. The Open next. We're 24 seconds away from the opening bow this morning. Good morning. 6 straight weeks of losses on the S&P. We equal the tally back to 2011. And a lot of you hoping we don't make it 7. Equity futures on the S&P down about 0.4%. On the Nasdaq, we're down 0.5%. On a Russell, down by a third. There's your opening bow. Switch at the board and get to the bond market. Yields look a little something like this, coming in a couple of basis points to 289.31. 6 weeks of losses on the equity market. We had 5 weeks of gains in 10-year Treasury yields, and then last week, yields lower again today by a couple of basis points. The euro just a little bit stronger. Euro dollar 104.23. Crude down 1/3%. 110.18. About 20 seconds into the open with your movers. Here's Abby.
John, let's hone in on some of the weakness that we are seeing for stocks here on the open. And of course, that has to do with big tech. The chips in particular. Last Friday, both AMD and NVIDIA up more than 9%, the best day in quite some time on that tech rally. Today, giving some of that back. I know that Taylor Riggs will be looking at some of the other names, including Twitter. To the upside, we do have Occidental Petroleum and some of the other energy names. The best sector on the day right now, Occidental Petroleum up 1.4%. In the pre-market, AMC, it had been trying for a third up day. The animal spirits part of last Friday's rally, not so much right now. Let's see how the day plays out.
Abby, thank you. About a minute into this, energy top of the pile up 0.4% on energy stocks. On information technology, down at 1% on the S&P. We're down 0.4% in the early part of the session. Big tech has been a big problem Taylor Reese has more. Hey, Taylor.
And John, the numbers you just pointed out, frankly, has been the theme for the year, right? Energy has been the big performer, and technology, again, just sort of at the bottom of the pile. And that continues a little bit today. We did a decent bounce on Friday, but remember, we're climbing our way out of a pretty big hole. And again, now in the opening market, out of pre-market, rolling over again, once again, when we think about some of the big tech companies. We talk about market cap here. The massive drawdown that we've had on the NASDAQ 100, you're now down in the hole of something like 26% from the latest drawdown of some of the latest peaks that we've had, some of the big record highs we've had. 26% drawdown. That is a pretty big pull down that we've had. You've wiped out about $3.7 trillion as well of market cap during that time. Of course, Twitter isn't necessarily big tech, but it's something that we talk a lot about on this program. So a little bit of the smaller big tech here. We'll just point out Twitter. Again, nowhere near sort of that 54.20 price target. A lot of price targets, John, given the buyout, was it 54.20? But a lot of the analysts that we speak to on the program, frankly, say like, that's overpaying, that it just isn't worth that much. So you see there, of course, around a 38 handle or so.
So if you go to the ANR function on the Bloomberg, and Taylor, you know this already, for other subscribers out there, you can find out what the previous price targets were before they all went to 54.20. I'm thinking of Goldman at 30. Goldman were at 30 before this deal came about, and right now, Taylor, 38. We're in the 30s.
Yeah, you know, and John, look, didn't Musk say that he was putting it on hold while he investigates some of the bots? I think a lot of the analysts struggled with. Everyone has sort of pointed out it was in the 70s a year ago, right? But as we know, the last price target is no indication on what a future value of a company is worth, particularly as we continue to re-rate all of these companies. So I am not hearing a lot that it's worth anywhere near 54.20, at least from some of the analysts that we speak
I'm
with.
sure Facebook would like to live in 2021 again as well. Netflix would like to live in 2021 too. Life doesn't work that way. Let's not get too deep and philosophical. Taylor, thank you. Looking forward to your coverage a little bit later. Way too early for that. I think it's always, it's never appropriate when we're talking about finance to get philosophical and deep about anything. Taylor, thank you. Twitter, 38. 54.20 the agreed price, and what a spread. It's ridiculous, isn't it? 38. I still don't know what putting a deal on hold actually means, but we can get to that later. A lot of retail sales earnings coming later in the week. Retail sales tomorrow on deck. Let's get to Kelly for more. Hey, Kelly.
Yeah, John, let's start with what we are expecting out of that retail sales data for the month of April. Overall, on the headline figure, expected to rise by 1%. But when you back out autos and gas, it's actually only expected to be a 0.7% increase. Really, what we're going to be looking for here is clues as to just how much higher prices have crimped discretionary spending and whether demand destruction has started to kick in. And that is going to be critical for the retailers reporting this week as we get their results. Just how much pricing power have they been able to exercise and the ability to pass on higher input costs that they are facing? Our analysts here at Bloomberg Intelligence, just looking at Walmart, for example, say gross margin actually could contract due to those elevated costs. We'll get those figures as well as Home Depot tomorrow, Target, Lowe's, TJX on Wednesday, Kohl's on Thursday, and several more to round out next week, all of which could bring insight into just how much consumers are willing to pay up for things that they want versus things that they need. It's really the difference between staples and discretionary that is front and center here. And from a stock performance perspective, we have seen staples outperforming discretionary by a margin of 20 percentage points so far this quarter. That is the widest margin going all the way back to 2001. Staples, the second best performer in the S&P quarter to date on a sector basis. Discretionary at the very bottom of the pack, down 19% over the period so far. And it'll be interesting to see if earnings reinforce that sour sentiment, John.
Kelly Lights, thank you. Awesome work, as always. This in my inbox this morning from Peter Tchir of Academy Securities, I think is so important as we think about this market over the last couple of years compared to this market, say, 10 years ago. These are the words of Pete. Most of the time, Wall Street tends to focus on big institutional flows. You're used to hearing that. For years, that was probably okay. Pete goes on to say, but that led to horrible decisions during the pandemic. Retail flows were a crucial driver of markets, and we are, what Pete says, we are at an inflection point where retail will be a big determinant of what happens next. I'm pleased to say that Pete joins us now. Pete, I was looking forward to catching up with you once I read this note. I'm always looking forward to catching up with you anyway. You said traditional versus disruptive portfolio construction. Let's start there at 35,000 feet and work our way down. Pete, what are you trying to get at?
So if we go back, traditional portfolio construction, you would be, here's some really risky assets, here's my core holdings, tends to be stocks, and then you've got safety, which is treasuries, money market, bank accounts. And I think what we really saw during the pandemic was what we're calling disruptive investors. And they came in and they want altcoins, NFTs as their risky part of their portfolio. they consider, disruptive tech, ARKK stocks, Bitcoin as their core portfolio. And I think they actually consider big tech as their safe haven, their equivalent of bank accounts. And so I think what we're seeing now is a big unwind of that. And you're seeing some phenomenal wealth destruction, right? There was phenomenal wealth created, it's being destroyed. And I think we're at this inflection point where people are going to either say, hey, I can double down, or I think much more likely, hey, we have to have some safety. I have to protect this wealth that I originally had that I've given so much up.
So Pete, work me way through it with you then. So talk to me about how that dictates how we perform on the way down and how we recover as we bounce.
So I think more downside to big tech. I think we're really watching the Apples, the Microsofts of the world. Do you start seeing selling in that as people actually really move to true safety? So, money markets, bank accounts, and this is across the board, right? We all of a sudden have much better yields than we did. The 10-year yield is now well above where the S&P dividend yield is. So I think you're going to see this shift where people say, I'm going to take slightly less risk for what looks like similar returns. And if crypto cracks at all, and I think Bitcoin really has that possibility given what went on last week, I think you see an accelerated sell-off in crypto, the disruptive stocks, and that drags everything else down with it.
Pete, I used to hate this term, the smart money versus the dumb money. What it used to mean was people really staring down their nose at the institutional versus, say, the retail being the dumb money and the institutional money being the smart money. And the point you're making here, Pete, is what has led us has actually been the retail flows. You're not the only one to make that point over the last couple of years. Jim Bianco of Bianco Research has been on top of that story too. So help me understand what our leading indicators should be and where we should look for them, where you would look to for them.
So I am looking at Bitcoin. I think if that cracks, it drags everything else down. And then I am looking at the Apples, the Microsofts of the world to see if there is that kind of selling pressure. They've started to roll over a little bit. And if I'm correct in these kind of disruptive investors who are holding those types of stocks as their equivalent of cash, and they're getting nervous, there's more downside there. And because those are such big components of the indices, it drags the S&P down and kind of takes the entire market down another, I think, 5 to 10% pretty easily.
Pete, how receptive are clients when you have this conversation with them and trying to explain why it's different this time compared to how it was in the last 10 years?
I think right now everyone's reasonably receptive because I think it's been such a difficult market to follow. So we're all looking for what makes sense. What can you say is a theory that actually looks like it's played out? And I think this one is resonating with people. They're seeing it in the flows. They're seeing it in their thought process. I think everyone wants to buy this dip. And that's the other thing. We keep talking capitulation. And yet, if you look at some of the riskiest assets, so TQQQ, which is a triple levered NASDAQ 100 ETF, it is at almost its biggest size ever, right? It's had nothing but inflows. So I do not think we've seen this retail capitulation. And that's what I think we're on the cusp of. And Bitcoin going down below, I think, 25,000 probably triggers that to me.
Pete, in terms of these two cohorts, are the catalysts for their investment decisions different? Do they respond to different things? The institutional investor, the retail flows?
Yeah, I think the institutional investor right now, if you're a large hedge fund, you're trying to stay close to home because it has been so volatile, it's so liquid. I think on the asset manager side, everyone's, again, trying to stay close to home to their indices. They don't want to be caught out. What I do think is if we get this final sell-off, people will be capitulated into it, and that will be the real buying opportunity. And the sell-off, though, will be led by retail. I think, investors on the institutional side are much more balanced right now than they've been in a long time.
So let's put a bow on it, Pete. It sounds like you want to buy, but ultimately, you don't think we've seen the lows yet.
That is correct. And I'm much more comfortable being overweight credit right now. I like credit where it is. I just think we have one more leg down in stocks. Having said that, I've been a big fan of energy companies. I continue to like that. I think we are going to see a lot of spending to revitalize our energy industry, and they're going to be huge beneficiaries.
What's the credit versus equity story for you, Pete? Just walk me through that.
So I think it's much more a valuation story, right? I don't think we're headed to a deep recession. We might get a small recession based on what's going on in Europe, but there's been such a big buffer and credit is so well protected. Plus with yields so much higher, I think you are going to see people move from risky equities into, say, dividend paying equities. You're going to see people move from dividend paying equities into corporate bonds into treasuries. So that's that rotation, which is going to be very supportive, I think, from going forward on yields and corporate debt.
Pete, do the retail flows ever come back in the way that they were built up, say, back end of 2020? Remember the short-dated call option volume we were seeing in some of these big tech names, single name stories, all that upside, and it just begets more selling, and then buying begets more buying. Pete, is that ever going to come back?
I don't think so. I think we're going to need to see VIX really come down so that weekly option game can, come back. I think Wall Street has gotten much more smart. They realize kind of this gamma squeeze game. So I think they hold the offers higher, and we're making retail chase. And that's over now. And I think you're seeing that it's even across the board, right? You look at the gambling stocks, they're all way down. Participation, what we call kind of this gambling nation, is really dropping off. There was a lot of excess liquidity. There was a lot of excess cash. People are getting free money, and they took that free money and kind of were very free and careless with it. That's now changed.
With that in mind, Pete, then, you've walked me through how the retail flows will dictate the bottom. It doesn't sound like you think they're going to dictate the recovery.
No, I think that's going to be institutional flows. I think it's going to be hedge funds realizing, okay, the worst is behind us. There's been a lot of pressure, I think, particularly from the CTAs who've been leaning on the market. So I think they keep trying to push futures down. So when we eventually get that rally, I think it'll be a very fast, vicious rally. People will look to pile into money. People will look to outpace their indexes. And I think the hedge funds have a lot of capacity to get net long here. So I think the final rally is really going to come from institutional investors, but we've got to watch retail, I think, for that leg down. So
Pete, this is important just in terms of the recovery then. Some parts of this market, I assume from what you're saying, will just be left for dead because that institutional money won't be in it in the same way retail flows were.
I think it's going to go back to being, a 2 to 5% of your allocation, where you can say, okay, I want some really, really risky assets that, might be, 5 times, 10 times within a couple of years. But this concept of I want 30, 40% of my portfolio in something because it could double in 2 weeks, that's over.
Peter Tchir of Academy. Pete, great to catch up. Interesting perspective, something we've not given enough thought to, I think, at least for me. I'm not going to speak for everyone. We're down about 0.2 on the S&P, about 12 minutes, 13 minutes into the session. Your Nasdaq's down by around about a third, but we have been all over the place. Coming up, NATO running around Finland and Sweden after announcing plans to join the alliance.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply.
That conversation up next.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply. And as to the differences between Turkey, Finland, Sweden that have been talked about, there's an ongoing conversation. And the bottom line is this: when it comes to the membership process, I am very confident that we will reach consensus.
NATO preparing to add Finland and Sweden into the alliance. This as Germany looks to halt Russian oil imports by the end of the year, with or without an EU agreement. The foreign minister saying the following: we still have to clarify a few things. That won't happen here today, but I'm very confident that we'll come to a conclusion in the coming days. Joining us now is Bloomberg's Anne-Marie, who tells us she is not on vacation. She's in Abu Dhabi. And Maria Tadeo in Brussels. AMH, I'll leave that for another time. Maria, just to you, the latest, please.
Yeah, well, Jonathan, we now hear from Sweden, also a confirmation from the Socialist Party in the country that leads the government. They say that they will apply for this NATO membership. Remember, there is a very important summit at the end of June. The idea is that both Finland and Sweden will make this formal step by then. And by the end of the summer, they will be full-on members of NATO. That's on the military front. When you look at still the perennial conversation in Europe, which is energy, once again, we hear from the Germans now say we're ready to pull on this oil embargo. But here's the thing, Jonathan, you have to look at the numbers. The number of oil barrels that are going from the Russian Federation into Germany have declined from 35% before the war to now 12%. So this is not a big deal for them at this point. What is a big deal is gas, and that continues to be a no-go. Also, when you look at the no-go, the Hungarians still say that they would veto any energy embargo or any energy measures that would lead their economy into a recession. So no consensus for the time being. This is now 2 weeks delayed.
Anne-Marie, on a serious note, what's the relationship between where you are and what's taking place in Europe, in Ukraine, and the situation with Russia?
Well, it's very interesting for the United Arab Emirates, Jonathan, because this has really been a safe haven for Russian money. Even if you look at the real estate market, a record start to a year. And a lot of that is because it's attracting Russian wealth. So this has been a place where oligarchs or elites in Russia can come and be safe and park their cash. At the same time, we have the United States asking the likes of the UAE, asking Saudi Arabia to pump more oil. Now, they're in this also interesting relationship because it took them years. And I was there for many of these years as they tried to cajole the Russians to join in on this OPEC plus group. And at the moment, they don't think that the market needs that oil. So it's a very interesting time, one, for this U.S. delegation to be here because of this war that is raging, because you haven't heard the Emiratis really condone what's going on.
The US would call Abu Dhabi, where you are, the UAE, a partner. I'm trying to work out how you define that partnership, Anne-Marie, at the moment.
It's a great question because it's been a tricky one over the course of the last year. And I think it comes down to energy and security. So from the Emiratis' perspective, as well as the kingdom's perspective, it has been tricky in terms of the Iranian-backed Houthis having strikes on both of these countries. And at the same time as Washington having talks with Iran and Washington having this urgency to potentially re-enter Iranian nuclear agreement. This is something that many GCC countries, all GCC countries, do not want to see. And then at the same time, you have Washington calling these capitals, asking to pump more oil, and they're not doing it. But what you have today is really a massive show of force. I mean, Jonathan, if you look at the list of individuals, the VP, and we just got a pool report that she had entered, and she'll be speaking with Mohammed bin Zayed, the now leader of the UAE. She is alongside the Secretary of Defense, the CIA's Bill Burns, climate envoy, John Kerry, who I traveled here with, Secretary Blinken. This is a massive show of force. And Norman Rowell, who used to work for the CIA, spoke to him earlier, and he said, if you look at the delegation, that can tell you what the signal the U.S. is trying to send.
Where do the Saudis fit in here, Anne-Marie?
Well, the Saudis have yet to get a visit as high level as this, right? This is the vice president, flanked by a lot of members of the president's cabinet. At the moment, there's a lot of negotiations behind closed doors, high level individuals that are going back and forth from Washington to Riyadh. And they're working on a number of fronts: investments, oil, and of course, defense and security, because Riyadh, like Abu Dhabi, doesn't want Washington re-entering an Iranian nuclear agreement. When it comes to the Saudis, though, what is going to be interesting, of course, is the president had campaigned on making this a pariah state due to Mohammed bin Salman, the CIA report about the killing of Jamal Khashoggi. And now you do see the administration making a shift. We had a recent call between the president and King Salman of Saudi Arabia. It's going to be interesting, though, potentially, Jonathan, what happens with the crown prince, Mohammed bin Salman, because at some point the administration will likely have to engage with him.
Maria, just on the energy front in Europe, what's the signal we should take away from the EU-level decisions that we have become accustomed to, from the Germans saying, OK, it sounds like we're going to have to go it alone?
Yeah, Jonathan, I think what they're trying to do is put an ultimatum on the table using something that is not going to have a shock impact on the German economy. If this was a conversation about gas, it would be entirely different. The fact that it's oil and they can manage to do that, I think they're trying to pressure everyone else to get on board. When the Germans in Europe, they send a political signal, usually that injects a lot of momentum in the conversation. So this is a move that in many ways is designed to get the Hungarians and Viktor Orban on board. For the time being, however, there is no shift whatsoever from Viktor Orban. He still says, as long as this damages my economy, I can't sign on to it.
Maria, I promised you a final word on the Eurovision contest over the weekend, and your great disappointment that Spain just didn't make it. What happened?
No, actually, I feel like the fact that Ukraine won this, the country's been through so much that really they deserve this. I think it was a moment of almost, catharsis for a lot of people. But Spain did great. She looks amazing. She sings, she dances. She's like beautiful. She's going to be a huge star. And, I don't get paid to say this. So this is really what I believe in my heart.
I know you messaged me over the weekend. You said you must watch The Lady and the Dancers from Spain. And I haven't made it yet.
This is quite diplomatic of Maria, I have to say.
Highly diplomatic, AMH, who is not on vacation in Abu Dhabi. Maria, today I was in Brussels. Maria, thank you to both of you, as always. From New York, equities lower, about 7/10 on the S&P. We're down 9/10 now on the NASDAQ. This is Bloomberg. 26 minutes into the session, all over the place once again. Nothing new here. We're down 0.5% on the S&P, on the Nasdaq down 0.8%. That's the price action. Here's the trading diary. President Biden meeting with the Greek Prime Minister at 3:30 Eastern. US retail sales out tomorrow morning, plus earnings from Walmart and Home Depot, and a host of Fed speak through the week. Bullard, Harker, Kashkari, Mester, Evans, Powell, all on the agenda. Finally, another round of initial jobless claims coming up on Thursday morning. From New York, new trading week, same story. Equities lower on the Nasdaq by about 1%. From New York, this was the countdown to the open. Thank you for choosing Bloomberg. This is Bloomberg TV.